Welcome to the deep dive. Right, so we've got this stack of sources you sent over, and they dig into something really complex, but, fundamentally important for the whole global economy. We're talking about the UK's financial services regulation, how it's always changing, this kind of regulatory architecture.
Yeah, exactly. And it's really not just about dry legal texts, is it? It's more like a forensic look back at decades of things going wrong, financial failures, and then, the scramble to fix the rules afterwards. It's this cycle of building trust, it breaking, and then trying to build it back up again.
Okay, so our mission today, really, is to trace that whole journey. Why do these rules even exist? Look at the big failures that, frankly, forced regulators to act, and then try and figure out how the system now is being shaped for, well, post-Brexit Britain and this whole digital finance future.
hmm And I think to start, you really have to get why this industry needs so much regulation in the first place. I mean, think about it. You, as a customer, you're putting huge trust in these big institutions, banks, insurers, lenders, and they inherently have massive advantages, don't they? Size, resources, but especially information. They know more than you do.
That imbalance is key, isn't it? If their main goal is profit and you don't have the full picture on risk, well, the system's kind of set up for potential problems.
It is. It's ripe for exploitation, potentially. And that fundamental vulnerability, that's really what Professor David Llewellyn got at when he laid out the three core objectives for financial regulation.
Okay, let's dig into these pillars then. The first one, and maybe the biggest, is to sustain systemic stability. This sounds like the global big picture stuff.
It absolutely is. It's all about the domino effect risk. The financial world is so tightly interconnected now, globally. So if one major player goes down, it can trigger panic, a sort of contagion that spreads everywhere. We saw just how close we could get back in 2007 or 9. The whole world economy was genuinely on the brink.
Saved only by massive government intervention.
Exactly. Coordinated emergency action, bailouts, liquidity, the works.
Okay, so that's the system level. Then pillar 2 hits closer to home. Consumer protection. This tackles that knowledge gap you mentioned. The asymmetric information.
Precisely. The supplier, the bank, or whoever just knows far, far more than the customer. And that creates the risk of mis-selling, pushing products on people that are just not right for them, for their needs or their situation.
Which ties into the third one, maintaining the safety and soundness of financial institutions.
Yeah, they're linked. Because if a big bank fails, it's not just about the bank itself. It creates huge anxiety for every customer who trusted them with money. And it causes massive headaches for the government, worrying about national economic stability. It shakes confidence across the board.
So those three goals, stability, consumer protection, institutional safety, they seem to demand different kinds of rules, don't they?
They do. And that leads to the two main types of regulation we see. First, you've got prudential regulation. This is all about managing the risks of a firm actually failing. It forces them to hold enough capital, enough money set aside from depositors' funds to cover potential losses. Like, if lots of borrowers suddenly default, it's their safety buffer.
Got it. The financial cushion. And the second type.
That's conduct of business regulation. This focuses on how firms actually behave when dealing with customers. So rules about being honest, acting with integrity, providing clear information how they market things, making sure their staff actually know what they're doing, that sort of thing.
The ethical side, almost.
Yeah.
How they treat you.
And the 2007-09 crisis was just a textbook example of both types failing spectacularly. You had lenders really loosening their lending standards, right? Giving mortgages to people who were, frankly, much riskier borrowers. That was a massive conduct failure.
And when those borrowers started defaulting.
Exactly. It quickly became clear the banks didn't have the prudential buffers, the capital, to absorb those losses, which led straight to the government bailouts, the market panic, the whole mess.
And that whole meltdown really set the stage for the next couple of decades of policy, didn't it?
Yeah.
There was this strange tension starting back in the late 70s. On one hand, deregulation, trying to boost competition, letting building societies act more like banks, that kind of thing.
Yeah. The Building Societies Act, 1986. The Banking Act, 1987. Opening things up.
But at the same time, there was this growing push for more rules to protect people.
It created this really complex landscape, and the early structures just weren't up to it. Initially, after the Financial Services Act in '86, they relied quite heavily on self-regulation, the industry policing itself, basically.
How did that go?
Not well. By the mid-90s, it was pretty clear that model wasn't working effectively. Too many conflicts of interest, perhaps.
And sometimes it takes just one big, dramatic failure to really expose the cracks, like Barings Bank in '95.
Oh, absolutely. A bank that had been around for over 200 years, brought down by one trader in Singapore. And the investigation afterwards, it really showed how fragmented the oversight was. You had the Bank of England, you had the stock market regulator.
And nobody was quite sure whose job it was to stop him.
Pretty much. There was finger-pointing, confusion over responsibility. It was a mess. And it highlighted the need for a clearer structure.
So that confusion led to trying to unify everything.
Exactly. That was the driver behind the Financial Services and Markets Act 2000, FSMA 2000 as it's known. This created the Financial Services Authority, the FSA. The idea was one powerful single regulator.
Covering everything. Solvency, capital, sales practices, compensation, the lot. For banks, insurers, everyone.
That was the plan. Around 800 insurance companies, 600 banks, all under the FSA's umbrella.
A massive undertaking. But even the mighty FSA, sitting there at the center, couldn't prevent the 2007 crisis, could it? It was part of that tripartite system.
It was. The FSA, the Bank of England, and the Treasury. Those three were meant to work together.
Wow.
But when Northern Rock collapsed in 2007, the system just seized up. You remember the queues outside branches? That visual was incredibly damaging.
Total panic.
Total panic. And the post-mortem showed the tripartite arrangement failed because no one was quite sure who was ultimately in charge. There was confusion over responsibilities, which meant delays in taking decisive action. And in a financial panic, speed is absolutely critical.
So the lesson was crystal clear. You need absolute certainty about who does what before the crisis hits, not during it.
Precisely. And the failure of that tripartite system led directly to another huge shakeup, a complete overhaul, really, which gave us the structure we have today, the Twin Peaks model, brought in by the Financial Services Act 2012, effective from April 2013.
Twin Peaks. Okay, so how does that split the power?
It's actually quite elegant, building on those two types of regulation we talked about earlier, prudential and conduct.
Yeah.
So, Peak 1 is the Prudential Regulation Authority, the PRA. Its job is the safety and soundness, the prudential side, but only for the really big, systemically important firms. Think of major banks, big insurance companies, the ones whose failure could cause widespread damage.
And importantly, it sits inside the Bank of England, right? Reinforcing that link between big firm safety and national economic stability.
Exactly. It makes that connection explicit. Then you have Peak 2, the Financial Conduct Authority, the FCA.
And their focus is?
Primarily, they are the conduct regulator for everyone. How firms design products, market them, sell them, treat customers fairly, that's the FCA's domain.
Okay, that seems clear. PRA for big firm safety, FCA for everyone's conduct. But wait, the SCA also does prudential regulation for smaller firms like IFAs, fund managers.
It does, yes.
Doesn't that muddy the waters again?
Yeah.
If the FCA is doing both conduct and prudential for some firms?
It might sound a bit complicated, but there's a logic to it. The PRA's focus is incredibly sharp. Only those large firms whose failure poses a systemic risk. The FCA regulates the conduct of all firms, big and small. But it also handles the prudential supervision, the financial safety net for the thousands of firms that aren't systemically important.
So the systemic risk is clearly ring-fenced under the PRA at the Bank of England.
Correct. And the FCA handles the day-to-day conduct supervision for everyone, plus the prudential side for the non-systemic players. And actually, the Bank of England and Financial Services Act 2016 further cemented this by making the PRA formally part of the bank, not just a subsidiary. It's overseen by a specific committee, the PRC, reinforcing that systemic stability mandate.
Right. Okay. So the structure seems pretty well defined by then. Twin Peaks is established. But then Brexit happens, a massive external shock. Suddenly, the UK has to figure out what to do with decades of EU financial law that was baked into the system.
Oh, that was a huge, huge challenge, a monumental task for the regulators and the government. The first step was basically damage control, keeping the lights on. The European Union Withdrawal Act 2018 essentially took a snapshot of all EU law as it stood on exit day and copied it across into UK law. Onshoring it, they called it.
Just to maintain continuity.
Exactly. And it gave UK regulators powers to tweak things, fix any technical glitches that arose because the rules were originally designed for the EU context.
So that was the immediate fix. What came next?
Then came the Financial Services Act 2021. This dealt with what was called in-flight legislation. These were EU rules that were already in the pipeline but hadn't actually come into force by the time the UK left the transition period.
Ah, okay. So rules that were almost there but not quite.
Right. The UK needed its own versions, often aiming for equivalence, making UK rules similar enough to EU ones so that cross-border business, especially with the EU, could continue relatively smoothly.
Makes sense. But just copying and adapting EU rules isn't really setting your own path, is it?
No, it's not. And that's where the most recent and arguably most significant piece of legislation comes in, the Financial Services and Markets Act 2023, or FSMA 2023. This came out of a big government review called the Future Regulatory Framework, or FRF review.
And the goal here was different.
Very different. This is about moving beyond just retaining or adapting old EU law. It's about designing a regulatory system tailored specifically for the UK's needs and ambitions in a post-Brexit world.
Okay, now this sounds interesting. What are the big changes in FSMA 2023?
Well, the headline grabber, the thing that signals a real strategic shift, is a new secondary objective given to both the FCA and the PRA.
A secondary objective. What's that?
Alongside their primary goals, like stability for the PRA, market integrity and consumer protection for the FCA, they now also have a duty to facilitate the international competitiveness and growth in the medium to long term of the UK economy.
Wow. Okay. Facilitate competitiveness and growth. That sounds different.
It's a major pivot. For years, regulation was seen primarily as defensive, preventing failure, protecting consumers, ensuring stability. Important stuff, obviously. But now, there's an explicit instruction to be, well, almost proactive, to actively support the financial sector's success on the global stage and contribute to UK economic growth.
So the regulator is not just a referee anymore, but also kind of a coach, pushing for performance.
That's one way to look at it, yeah. It's a significant change in mindset.
And alongside this new growth mandate, are they getting more power to actually enforce the rules?
Yes, definitely. FSMA 2023 beefs up their enforcement toolkit. Stronger powers to intervene, stronger action against firms that don't comply, including potentially higher financial penalties for breaches.
So incentivizing growth, but also cracking down harder on bad behavior.
That seems to be the balance they're aiming for. And it makes sense, especially as finance gets more complex. The Act also introduces something called the Designated Activities Regime, or DR.
DR, what's that for?
It's a way to regulate specific, potentially high-risk financial activities that might not fit neatly into the traditional categories of banking or insurance. It allows for more tailored oversight.
Like what sort of activities are we talking about? Things that maybe didn't exist 20 years ago.
Exactly. Think about certain types of high-frequency trading, maybe specific aspects of digital assets or cryptocurrencies, new payment system technologies. These things can carry significant consumer risk or even systemic risk, but they need rules designed specifically for them.
So it allows the regulators to be more agile, to target new risks as they emerge.
That's the idea. It provides flexibility. And importantly, the 2023 Act explicitly encourages innovation, particularly in fintech and digital finance, while trying to ensure the regulatory framework can keep up. It's a balancing act.
Okay, so let's try and pull this all together. For you listening, what does this whole journey mean? We've gone from, fragmented rules and self-regulation that didn't always work, through the shock of the tripartite system failing during the financial crisis, to land on today's Twin Peaks model, the PRA and FCA, which seems much clearer, but it's constantly evolving, constantly adapting.
It really is. The core theme is trying to manage risk and maintain trust, and rebuilding that trust every time it gets broken. The UK system now, especially post-FSMA 2023, is arguably one of the most sophisticated in the world. But that big implication, that strategic shift we talked about, adding competitiveness and growth as an objective, that's the really profound change. Regulation isn't just about stopping bad things happening anymore. It's now explicitly part of the strategy to make the UK financial sector succeed globally.
It moves it from purely a defensive posture to something more forward-looking, maybe even offensive in a strategic sense.
It's about shaping the future, not just reacting to the past.
Which does leave you with a fascinating thought, doesn't it? With this new explicit focus in the 2023 Act on boosting fintech, digital innovation, and international competitiveness, how might that change what we even mean by systemic risk in, say, 10 years' time, when maybe the biggest risks aren't from traditional banks failing, but from complex algorithms interacting globally, or failures in digital infrastructure we can barely conceive of today?
That's the billion-dollar question, isn't it? How do you regulate for risks you haven't even fully identified yet?
Something to definitely mull over. We'll leave it there for this deep dive.